Hello, everyone. Welcome back to the Unpolished MBA. And yes, we are still doing the series on the Acquisition Chronicles. There are so many things about the process that needs more details, more color added. So, on this episode, I am being joined by a special guest. Her name is Yvette Owo, and she was on a previous episode of Unpolished MBA last year. She is an acquisition entrepreneur. She actually started an accounting firm and then she bought one and added it to her existing business. So we talk about that, but her business is in the space of accounting and doing quality of earnings and financial forecasting and all of those things that apply to anybody that's operating and owning a business. So we dig into that, but there is a emphasis on the quality of earnings because that's a big part of the acquisition process. And so throughout this conversation, I share with her some specifics from ones that I've actually had done. And I think this information will be very insightful for you all. I would say grab your pen and paper and take some notes, or if you're pretty clever, you will take this episode and have it transcribed online so you can read it. And then that way you don't need to write things down. With that, let's go ahead and hop into the episode. I just wanted to say this was, we've been talking about on this series how the experience of an acquisition or operating a business overall is different depending on your, demographics. If you're a woman, if you're a person of color, if you're young, if you're old, like everything is different based upon literally what you look like. Like seriously. And in
Yeah.
one of the episodes, I told Jed Morris, who has been joining on this series, he and Kenza Asmat, he was talking about his experience with acquiring. And he was explaining his experience like, hey, I tell him this. And it's either take it or leave it, or I'm out of here. And we're like, well, that must be nice. Like, I first of all, that is definitely a privilege that you with a military background. Like, I'm gonna be professional, but I'm gonna get stuff done. You know what I mean? Like,
Yeah, and I think there's also different backgrounds. Like the way I was raised to be nice to people, regardless of whether or not they were nice to me, regardless of whether they cared about me, regardless of whether they're supportive. And so now you have people who count on you, who are your clients, people who count on you to pay their bills, who are your employees, and some of them are lying to you on all sides. Some of them are lying to themselves, right? Just
mhm.
like so, you have to be able to cut the BS and get to the truth. And so some people don't always want to hear the truth, but if that's what your job is as CEO, like everyone can't know what you know. So you, by definition, have to know things other people don't, share with people when it's necessary. Get your job is to, if two coworkers see that one coworker is not doing the best job, most likely they're not going to go to their peer and be like, hey, you need to step it up. They're going to go to you so you can deliver the message, right? So I've been reading a lot of books about um, I read No More Mr. Nice Guy, which is kind of a little frustrating because the book is actually about a topic that women have been dealing with for decades, but now it's becoming a crisis within men. So there's more books about it.
Hmm.
Um, and then I read another book called About Boundaries by this coincidentally Black female psychiatrist or
Hmm.
psychologist. I'm not sure. But yeah, it's been incredibly helpful. Neither of them are business books, but and fundamentally a lot of businesses boundaries. So like when
Yep.
you're trying to disengage a client and they keep asking for one extra week, that's a boundary violation. That's a boundary violation for yourself and the team. When a client asks you to get something done tomorrow that's unrealistic, that's a boundary violation. And when you're trying to be nice as a leader, well, your niceness means, okay, you're overworking your team. So
Right.
what you're really saying is that like, I'm uncomfortable and and I'm trying to avoid this temporary discomfort. So in the moment when you say no, like I had this one client actually threaten us because she was like, your team is not working hard enough. You're letting them take New Year's Eve off and Christmas Eve. And I don't, respect your leadership skills because she wanted
Wow.
something. Yeah, she called on a right before Christmas and she wanted something done the next day, and that was not possible. So she wanted it on Christmas Day. And I explained to her that that was not possible either. And then, so, then she wanted me to write a letter. And I was like, we didn't audit you, so we can't do that. Again, those are all moments of discomfort. Every single conversation with her has been a moment of discomfort. Every single conversation my team has had with her has actually been a moment of discomfort.
Yeah.
In saying, okay, after this is done, we're not working with her again. I built trust in them. They know I'm going to protect me, and it's very also hard in accounting.
Mhm.
You'd be surprised the stories we get. Like when people's parents die a year and a half later, and they need something done in a week, they call us. So you have to be really clear about boundaries and really proactive, and you really genuinely want to help. And so you got to find that balance. But also, if I say yes to everything, then my staff has no holidays, no vacations, no time off, no training time. Um, and then we're just getting things out the door, and our quality of work is actually getting lower. And then our clients are learning to treat us badly. So going back to what you were saying, all of these are like things around boundaries, and neither of these two books are business focused. They're just about the idea of boundaries and taking care of yourself and knowing what you want.
So, would you mind mentioning the titles of those books again?
Not Nice is the book by Dr. Aziz. And the next one I'm reading is Set Boundaries, Find Peace by Nidra Glover Tawib. So 2 good books by 2 really solid professionals.
Okay. Thanks
Yeah.
for sharing that. I'm going to put the links to that in the show notes. And this definitely brings full circle one of the conversations that we're having today, with the focus on acquisitions and the work that you do. You have been a guest in the past,
Yeah.
and I appreciate you coming back. You're one of the smartest people ever in your industry, and everyone knows you, which is great, and respects the work that you do. I mentioned that you were coming on the podcast. Unfortunately, my guest co-host can't be here today,
Oh,
but they're
yeah.
like, "Oh no, I'm missing you back this time." I was like, "Oh, y'all gonna miss her," but they'll be tuning in once we're done and uploaded here.
Yeah.
But this brings me to what we're going to talk about with the quality of earnings. And it's one of those things where I found researchers really have to like stand up for themselves in pointing out if there are any disparities or asking questions or things like that. And particularly depending on your personality and your background, your boundaries, all of that, a lot of folks are really comfortable with it. And honestly, it's one of those things where they don't want to the seller to feel like they're being overly questioned or scrutinized
Right.
in a transaction. But I think there has to be a balance there because the information imbalance is like insane when it comes to acquisition. Good grief.
Yes. 100%. You will learn more in the first 30 days post acquisition than anything else.
They know so much more about everything than you.
Yes. I think the biggest challenge with the quality of earnings reports, for those who don't know what it is, sometimes people just call it financial due diligence, but it's a specific report that typically an accounting provider does. Finance folks are getting into it. But the background is actually accounting, because accounting is historical, finance is forecast, is future. And it looks at the numbers. So anyone can give you information in a spreadsheet
Okay.
and tell you it came with books or it came from any software whatsoever, right?
Mhm.
So a QOE goes in and actually analyzes the numbers. Sometimes they'll find errors very often we'll find errors in people's QuickBooks, which could be to your benefit because, um, you find an error in the QuickBooks and then you're like, this business may actually be worth, more than they know because of an error. We've seen that where it's like, oh, there's 50K to the bottom line, but
Mhm.
also errors where it's like, okay, well, hold on, this is a mistake. the pricing that you have is wrong because there are costs that are missing, or sometimes people just like put things in the wrong categories um, when they're doing their bookkeeping. And so we've seen like, okay, hit pause. We actually need to reprice the deal. So
So
that's one
give
option.
me an example. Give me an example of they have their chart of accounts, right? And their categories of how they're allocating things. What is something that they've allocated mistakenly to the business? Like, give me an example of something that would be.
I mean, like there could be like one is a simple example is like the brokers will often say that X, Y, and Z is not necessary for you to run the business. So you can take that expense out. But it's not necessary for you to run the business.
Oh,
That just means
okay.
so that's one example. The broker says it's not necessary. Another example could just be simple mistakes. Sometimes like things go on the balance sheet instead of the ex but they don't go on the P&Ls. And so people don't always know the difference between the balance sheet and the P&L. So like there could be
Mhm.
issues there. Someone could just have legitimately miscategorized stuff. So it it doesn't mean that the person is doing anything bad. Like because you're assuming, first of all, that the business has good bookkeeping, right? I mean,
Mhm.
kind of like assuming everyone eats their vegetables. It just it's just kind of like,
They're alive, they're breathing,
yeah, you know what I
Yeah.
mean? Like people look at me and they're like, "You're in shape." Actually, I have a health issue. I haven't been to the gym in years. I just eat well, right? Like I figured out one part of the equation to be in
Mhm.
shape. But if you wanted me to like save your life or something, I mean, unless it's usually like using numbers and words, like suddenly find somebody else.
Okay. Yeah, I see
Right.
what
But
you mean.
right.
Mhm.
Right. So what I mean is like that appearance doesn't necessarily mean that everything is okay in um the background. So just because the business is operating, I mean, there's one business with $75 million and they didn't even have a balance sheet. Like they had a whole bunch of assets, like machinery, and they
Mhm.
just walked around with a sheet of paper and they were like, "Oh, I think this is how much this costs." And they're a $75 million business. So they obviously know how to make money and stay profitable.
Mhm.
Um, but they're not into the finances. Like they're just not into it.
So, I know that this is a part that folks like to skimp on. They don't wanna spend the money on it because they don't know if the deal is gonna go through, and it's gonna cost anywhere from I've seen them as cheap as, like, 5,000 up
Mhm.
to, tens of thousands for us regular folks. I know private equity will spend 6 figures or whatever on these things.
Yeah, I think in SMB small businesses, you probably see them up to anywhere from 5,000 to 25,000. And people will say, "Can you get it cheaper?" You can always get it cheaper. Find a person who probably just left an accounting firm who wants to buy a business so they don't have steady income, and then ask them to do it.
Hmm.
And they will yeah,
So
whether or not they know what they're doing, whether or not they never if they never done it by themselves without being part of a team and never had a partner there to review it, all of these things are things that you are betting on, right? Like there's a reason, like just because I can do part of something as part of a team doesn't mean I know how to do the whole of it. But you can always find someone cheaper for every service you want, whether
that's
it's marketing
true.
strategy, like, you can always find someone. And then if they've never priced it before, they also don't know how to price. So you're taking
So
advantage.
I have to ask this question though, because this comes up a lot in the search community. What determines what's an appropriate price for a QOV? How is the pricing determined? What
Well,
should
I mean, the
hand?
pricing is determined change just like any other service, a little bit by just how desperate the human is that's selling it.
Okay.
Uh, but then also, I mean, a QOV also it's like this. How many deals has that person done? If the person's done a ton of deals, they can find issues faster, right? If you're just looking for
Okay.
someone that can crunch numbers, okay, they're crunching the numbers for you. But a person who's done a ton of deals or like if you're working on my team with someone who's actually bought a business, they're like, yeah, okay, I see this error. Also, another deal this happened. Here's what we suggest. Or, oh, you're looking to hire a general manager. Well, actually, there is extra, $170,000 that's unallocated that you could potentially use for that, right? That's an
Hmm.
advice that you be getting from someone who's just, so there's companies that will just spit out a QOE, which means they'll get numbers. And if it takes 2 days, that's kind of what's happening. It takes 2 days or a week. Um, you can get numbers, crunch through them and spit it out, but you want advice, you want guidance, right? And so the more experience someone has, I mean, that's going to influence pricing. Also, the more the person wants to take the time to really dig into everything, right? So it's kind of, there's a saying in business, you can't get it good, fast, and cheap. You're
Yeah.
getting 2 out of the 3, and you got to decide which one you want. So the real question becomes, what's the value? So lawyers have been around forever, and people make fun of lawyers, but lawyers, we have been, I mean, even in Downton Abbey, they had lawyers. Even in Downton Abbey, they had doctors, right?
Yeah.
But I mean, so we respect the profession just because we know it's important and necessary because it's been around so long. But when it comes to a QOV, it's like, well, I didn't hear about that until 6 months ago when I started search. I didn't know what that was. Most people don't know what investment bankers do. They don't know what strategy consultants do. So part of the lack of value is if people just don't understand it. Right. And so it is something that's typically within an accounting scope. And another thing people don't know is accountants specialize like doctors. So you have someone who just Q&As as their bread and butter. They know the process inside and out. They know what kind of gotchas to look for fraud. They know what kind of gotchas to look for mistakes. They will often fix the books, which on your side, so the numbers you're looking at, so people, it's not just an analysis, like the numbers you're looking at are actually different from the numbers the business is looking at, because now you're looking at correct financials.
Okay.
So let's assume there's fraud a lot of times, like open fraud, and then there's just mistakes. Then there's you're thinking, okay, well, I want to add marketing. I want to hire this role. Where am I going to get the money from? Well, now you've paid a whole human to understand your deal and understand your numbers. Ask them.
I see. So when you say there's just outright fraud sometimes, what's happening? What
All kinds of stuff. People will like pretend to they will buy their own product to raise revenue.
Oh gosh.
Yeah. So if you just look at those P&Ls, you'd be like, oh my God, revenue is so high. But they bought the product and you didn't know that.
Okay.
Right. So you can't find all types of fraud, but you can find stuff, or they can just not put something on. It's like, wait, we're missing the accounts receivable or you see sometimes like accounts receivable is always the same. Always the same. That's just not true. That's like maybe they didn't track it. And now they're just suddenly tracking it. Or like inventory value. It's like, nah, man, like you've used depreciation, you've had this asset for a long time. That inventory is not valued at that price. That doesn't make any sense.
Yeah. Yeah.
So if you don't build QOE, you're trusting one, that the person is honest, right? And also two, the person is freaking fantastic at financials. The average US American, what is it? 40% of Americans or something like that have $600 in savings.
Wow.
So you're trusting that this person is fantastic at running their business, running all the people, all products, all the clients, and at the books. And even if they have an accountant, you're trusting that accountant is fantastic because, one of the issues in our industry is accountants say yes too much and then they get overworked and, that causes mistakes. And also like people don't respect accounting and accountants tend to be conflict adverse. So that push that you made to get that $200 off, okay, you got the $200 off on that work that you got your accountant to do, but that team is probably now working, they have fewer hours to do the same work for you and they're getting paid less. So if you're asking for that and another person, well, they got to cut something. Maybe we'll cut training.
Oh.
Research. We'll cut bonuses. So, you got to really think about you might get it and you might feel good. But especially if it's a long-term accounting relationship, if they're saying a lot of yeses to you and you're being really pushy, or if you're asking for a bunch of stuff off that you wouldn't ask your doctor or your lawyer or Walmart or Target or any other place,
Yeah.
then if they're saying yes to a lot of people, they're having to make cuts internally to make that happen.
Mm. Wow. Okay. That is a big consideration that I don't think a lot of folks think about when they're asking for $100 or a couple $100 off. Is it really, really worth it? Um, okay. So when we go back to fraud, I don't know if this is strategic or if the seller is in his own way showing a lack of integrity. So, a deal I was looking at, the revenue was pretty consistent over, the 3 years. And then the year during the transaction, uh, during the we were under contract, it showed a spike in revenue. And as I looked at the P&L, I didn't see any increases in, inventory turnover. Like materials and supplies need to be used to create the
Yeah.
value.
Right.
And so I didn't see that. And the QV person that was hired for the deal, the firm, they didn't mention anything about it either in this,
Right.
20-page report. So I did my own investigation and
Uh-huh.
I found that the seller was able to close on a significant deal with someone, but outsourced it to a friend,
Mhm.
and the friend actually carried out all of the work. And then they were able to do a revenue share, which increased the revenue for this company. However, it decreased the margin because they had to pay someone else to do the work, right? And so the increase in revenue actually declined the EBITDA, if that makes sense, right? And so it was one of those things where honestly, I thought that after having a QV provider involved, just like you mentioned, they're smarter
Yeah.
than me at this stuff, that it would come up, but it didn't.
Well, again, there's lots of different providers. I can't speak for what everyone does. There are providers that typically work with banks, and then occasionally a searcher will come if you're and they typically do valuations for banks and they can turn them around really quickly. That's a different client, different asset, different needs. Like so, and I don't know, were you asking those questions throughout the process of the QOV? Like, hey, why is revenue super high?
Yeah, and well, not throughout the QV. They did it and it took, several weeks. So
Yeah.
I'm glad it didn't take a couple days because now I know it shouldn't. um, but this was a while back. So
Yeah.
um but when I was looking at the numbers, inside of the QV, there's lots of explanations for things like fluctuations due to
Yeah.
COVID, all of those things. And to me, this was glaring. I mean, hundreds of thousands of dollars
Yeah.
that I would think it would need an explanation.
I can say that, when we see an increase in the year before sale, I mean, one, lots of sellers increase the year before sale. So if you see revenue that jumps, that means it's not consistent.
Yeah.
And they probably want to price it on that year. And we'll
Yep.
advise you don't do that because the business you're buying is not a business that runs like this.
Mm.
Either people have worked harder this year, maybe they went above and beyond for marketing, maybe they changed some processes. Um, maybe they said yes to some business that they normally wouldn't have said yes to because
Mhm.
it's good long-term business, but you won't know that until you get back into until you get into the business. Not all clients are created equal. So there could be clients that would have said no to in the past, but now they're saying yes because it's going to juice revenue, right? Sometimes people cut some costs at the end of the year. So normally you see this uptick because you really are supposed to plan for your sale 5 to 3 years out. But most
Yeah.
people don't plan that far. So then the last year is when they want to juice it and then they want to price for that. So then we would also say, like, you shouldn't price for that because that's not the business you're buying. The business you're buying is the one for the 2 years beforehand.
Mhm.
And so we
See,
would have adjust EBITDA actually based on that and do a kind of a weighted average. So we look at the change over time. We're asking questions of, okay, so, if you have more revenue, it's an inventory based business, when did you buy the additional inventory? Did you sell off some of your old inventory that was sitting around? If it's a services based business, where are the people who did the work? How did you get that done? So that contractor costs, you said they outsourced it, but that should have also been in their P&Ls because that's a cost.
It was, but it was placed under, um, rents and leases. Like,
Oh, okay. Well,
yeah,
that was
yeah, that's my thing is that the QV report didn't mention any of this, right? Or, I'm sure they saw it because I can see the actual number in the
right.
revenue, in the report that they see. Okay, that was, 500,000, now it's 900,000. Great. So now is this and now is that. But there is a section typically in the QV that says, actually, I'll read the header to you. It
Hmm.
says key deal issues,
Hmm.
right? And that's actually a header.
Yeah.
And I literally, I searched and searched. And as you mentioned, did you ask? And then I asked, what their
Yeah.
thoughts were. But and my question is, because you do this, what are the expectations? Like, what am I paying 5,000 for as opposed to 25,000 for? If
Well, I think what
something
you
like
just said
that.
is one of the differences. So
Okay.
someone crunch numbers. So numbers are in formulas, right? The proof of cash is something people always talk about. That's one. But there's even ways to kind of do a detailed proof of cash where you actually look at every single transaction from start to finish. And then now there's like, oh, there's this software that it can do a proof of cash for me. And we can use AI. Don't know how
Mhm.
that go. And then there's like ways you can try to shortcut the proof of cash to lower the cost. So did they do it the more detailed way or do they try to do it the shortcut way? Right. That
Okay.
doesn't go into as much granularity. Um, so and that question can be asked throughout. If we're looking at working capital, did they look at how the working capital fluctuated over the last 3 years? Or did they
Yeah.
just calculate working capital for the last 3 months? Or do they do a snapshot of every 3 months, every rolling 3 months? So
Yeah.
there's a level of detail to every calculation. And also you can track it over time, or you can track it over a 3-year period, you can track it over a 1-year period.
Mhm.
You can track it over different increments. So those are all the different types of things that, when you're doing a light, it's like, what is the bare minimum to get something out the door? And I don't mean that negatively from the friend side. I also mean that the client's basically saying, what's the bare minimum that I need? It's like, I'm going out into the cold, right? Into
Mhm.
freezing cold weather.
Mhm.
What's the thinnest gloves that'll protect me? What's the
Oh, okay.
smallest jacket that'll protect me? And so then the QV light was created because people started asking, what's the bare minimum?
Yikes, that is not good. Folks listening to this, please keep in mind the difference between being offered a Q of E light and a full
Yeah.
service one. Because
Yeah.
the Q of E light, I have different ones for different deals. This Q of E light that I have for this very first deal is 32 pages long and it's
Yeah.
light. I would say people think because of the length of it or however many PDF
Yes.
pages there are, can be related to the complexity or the amount of analysis. And that's actually not true.
Yeah. And there's also like, how long was the industry overview section?
Um, so I just want to say this from all the ones I have, I still say that that is generalized. So that
It
is,
is.
I mean, way too general because they don't. So the industry section is 1 page.
Okay, that's good. Because one of the ways, especially if you have a general industry, because industry stuff is kind of refreshes every year. And
Yeah.
so you can just, if industry's 10, 5, 10, 7 pages, 3 pages, you can just kind of copy and paste that, right?
Hmm.
Um, but hopefully the person who's bought the business has done the general industry overview beforehand. Not saying that the QOB doesn't include some, But, you as a business owner or potential business owner should really know,
Yeah.
the big trends in the industry before you're getting into this. Like, if you
Mhm.
think of macro, this is someone helping you with micro. So macro is like the big environment. Someone helping you with the very specifics of this one particular business.
So this is what I'll say. The Q of E, I'm using the same example that we've been talking about through this
Yeah.
conversation. I found that this one just pretty much copy and pasted what was in the sim into the Q of E. So the words that the seller and the broker used to describe the business and the industry is what is now in my Q of E.
Well, probably wouldn't go back there
That's
and do
not okay.
anything. Yeah.
It's it's a very well known one, by the way. A lot of
Okay.
people use them.
Can we just be clear that it's
It's
not
not
me?
you. This is not it's not your little accounting, you guys. If you want it done right, if you listen to this episode, you want it done right. Listen to the way she's explaining things. So
I can just say that, our job is not to paraphrase the broker or the banker. Our job is to create our analysis for you. I buy, right? So when I buy and on our internal team, we have sellers EBITDA and we have buyers EBITDA. It's a
mhm,
different calculation. Our job is to create that number for you
mhm.
and answer those questions that you have, give you opportunities to potentially lower the price if it's unrealistic, or change terms. Our job is to look out for you. And also, you're going to run the business differently.
Yeah.
So if you're going to hire different staff, and this is where I think that's a big difference. If you're like, I'm going to hire these different staff, well, we can't it's not even just fixing the ad backs from the broker. It's, okay,
Mhm.
well, if you hire the staff or fire the staff, what does the numbers look like for you? Totally different. If you think back to private equity professionals doing this, they're
Yeah.
not going to can you imagine one large business taking financials from another one and being like, "Oh, okay, thanks for doing all the work. We trust your accounting department." Absolutely not. Okay, when we plug it into our infrastructure, when we plug it into our costs, this is how much it's going to cost us to run this business.
Mhm.
That's what we need to understand on your side as the buyer. And that's what you're trying to understand sooner rather than later. And there will always be surprises. And that's why we love the continuity of being able to help with a QOB and then do the 13-week cash flow at post close because it's gonna be cray. Your experience in that first, quarter, so many expenses are gonna come up that you've never even heard about before. And you're like, what is going on here?
Mhm.
Um, things that it might be like, I need to do Wi-Fi in the office. And you're like, what do you mean? Like you never, you assumed all offices had Wi-Fi. Like it was just never, you never thought that was a question I need to ask.
Mhm.
You don't know the things you don't know. And so having continuity of guidance also helps, but really in that QOB, you want to be able to ask questions. Um, you want to be able to try to plan for the business that you're going to and how you're going to run it. So think of it as you getting your own calculations of P&Ls. One, checking the seller, but two, with the way you plan to run it, what are the financials going to look like?
That's that's an interesting perspective because with the one Q of E, they didn't ask me about that. They just kinda did their thing, right?
Well, I mean, in the SMB space, you're but most first time sellers are just like, what's the cheapest thing I can get?
Yeah.
Or what's the bare minimum? So if you haven't educated yourself on it, how would you know?
Yeah.
Again, think of yourself as a business, not a searcher. If
Mhm.
I were Microsoft and I were buying a company, would I figure out how much it's going to cost me to run it?
Right.
You're buying a business. You're going to own this business.
Mhm.
You think of it as a business. So you need to think about how you're going to run the business.
Yep. So there's this one you just mentioned about your staffing, making staffing changes. If you're gonna fire someone, hire someone else, it's still hard to know being an outsider, right? It's not until you get in that you're like,
Yes.
during due diligence, I do a thorough HR analysis, get all the employees, their positions, how long they've been with the company, their job titles, like all kind of stuff. Do they have benefits, their bonuses? Do they, and we do an analysis and it was this one company. I'm like, this person is here and they literally really only do work if they have this kind of project. Like,
Mhm.
if the business gets this kind of project, which they might once a year,
Mhm.
but this person is on payroll
Yeah.
all year. So I can think in my mind, just looking at the paper, I asked the seller, hey, what's this person do? Oh, they're so and so's assistant. Well, I'm like, okay, so it's their assistant. Like, what exactly do they execute on daily? Oh, they help so and so with it. Like, it was almost like an hourly employee's
Mhm.
personal assistant on staff. And so, of course, I can think, "Oh, no, I mean, why would we need that?" As an outsider looking in and
Yeah.
make plans to eliminate that, but then I find out, maybe this is so and so's child or girlfriend or niece or whatever, and if I try to get rid of that person post-close, that other
Yeah.
person is gonna give me a hard time or leave, and then that also degrades the value that we're trying to maintain and
Yeah.
grow in this company. So it's so many arbitrary what Imma do when I get in. This is the thing with searchers and just in general in acquisitions. This is what
Yeah.
Imma do when I get in. But the imbalance of information.
It is huge. And it's interesting when I said changes, you assumed elimination.
I know
Um,
for me, because I was just thinking about that particular
well,
situation.
and that's it. You have to be sensitive with eliminations because people do have relationships, and
Yeah.
letting go of one person who may need to be let go may mean you need to let go of another person who may be okay,
Mhm,
but because of the familial or social relationship, it's like, do I keep a D player so I can keep a B player? No.
mhm.
um, but I think the other thing to think about is this is a plan. All business plans, like they never know what the future is going to happen. Like, it's Mike
Yeah.
Tyson said, everyone has a plan so you get hit by a face. Buying a business is just get hit by a face on a daily to weekly basis. Right? So you actually have a starting point where you can say, here's the financials, here's what I planned out, and then you can be readjusting. And so a
Yes.
lot of times also the QOV person or vendor stops, and then you have another accountant that helps you with your ongoing work. So we can do it continuity. We have continuity where we can do your QOV, and then we can do your bookkeeping, and then we can help you through forecasting. So it's very realistic to know that things are going to change. This
Mm,
this person or thing that you thought you would cut out doesn't make sense. This
mhm.
person or thing that you thought you would add in costs 3 times as much. Maybe their IT managed service provider is like, oh, so great on paper. And then you get there and you're like, oh my God, it took me 2.5 weeks to get access to my email. I need to change this vendor ASAP. Or
Mm,
maybe you try to work with the vendor, then you realize nothing's going to happen. Then you need to change that vendor. And you need new vendors that are more expensive. But if you keep using the same vendors can actually hold you back from growth. So yeah, things are absolutely going to change, right? That is the nature of the beast. That is why people don't want to be CEOs because they would rather have a job where your salary is steady until a scheduled promotion or scheduled bonus. And then if that schedule doesn't happen, you get angry and you quit. CEO who is
No
like,
quitting.
yeah, but I'm just saying, I mean, like,
Yeah.
that's the difference, right? Like an
Yep.
employee has like, here's your salary for the year. If you get bonuses, here's your bonus opportunity. If you have overtime, here's your overtime kind of structure. You have all of this structure to know how your income is coming. And you kind of know what your job is like. A CEO, it's complete opposite. You don't know if COVID's going to come and that's going to affect your revenue. Well, that needs to now affect your cost. You don't know if your vendor is going to double cost. So you have to look at, it's funny, I have a staff member that used to have his own company, and he now describes it as or being an employee. He calls it having revenue without costs. Because other people would say, "Oh my gosh, I have my salary, like my income." He's like, "No, no. When I try this running and accounting for myself, it costs me." He was like losing money for every client that he made because he was spending so much money on customer acquisition costs, trying to learn marketing and stuff like that. So it ended up being a negative net loss, not because he's a fantastic accountant,
Mhm.
but running a business and doing the thing are very different things,
Yep.
right? And so to your point, Monique, the plans do change and planning is part of the job description.
The thing is, you mentioned that you guys could do the QV and
Yeah.
then have the continuity. So as we
Mm.
get in and we see, oh, this was not really what we thought it was going to be. And we had these great plans. In
Right.
addition to that, you help with the bookkeeping
Yeah.
and
So,
forecasting. Okay.
and taxes.
Oh, and taxes.
Yeah. So it's a full
Okay.
service shop. So
Okay.
part of this vision is I used to work with like Fortune 50, Fortune 110, really large companies. And one of the benefits that large businesses get that small ones don't is they can go to specialists when they need, but they can also go to one company where several people have different skill sets.
Yeah.
So when you transition from one phase of something to another, it's not like, oh my God, I have to reteach the company all over again, or there's all this information loss. It's like, okay, Jennifer did it and now she's talking to Jackie. And as part of the transition, they're speaking the same language, they're explaining each other the book. So you don't have as much loss of information. And that's a huge, huge advantage that people don't think about is every time you're changing vendors through a process, you're losing information and you're losing traction.
Yeah.
And there's like upfront costs, like restart costs associated with that. So that's a huge advantage. And I wanted to bring that to the SMB space.
Well, thank you for that. Okay. I know that we have to wrap this up. I'm going to tell you a few of the sections that are in this one that I think is a
Yeah.
pretty good QV.
Yeah.
So there is that section that is like the executive summary.
Yeah.
And, that's just a one pager. Then there's a financial summary that's basically the income statements from the company over the 3 years. And then
Mhm.
the trailing 12 months,
Mhm.
right? Are in a
So, and it's the
report.
income statement as they provided it or adjusted for you?
So when it just starts off, it's just as they provided it. Then further in the report, it
Okay.
it's different for the seller versus me as the buyer. And
Okay.
you mentioned that was good. That was something to expect in the Q of E, correct?
Yeah, that's something that you would want in a
Okay.
QA. And then even then, so do you have and then even then, like you talked about they could do headcount analysis, revenue per customer. So even in that section, there could be
Yep.
ratios.
We
So,
did that. That's
okay.
in there. Yep.
Yep.
So here's the thing. I had done that anyways. I didn't realize the first time I got a QV done that
Yeah.
the QV provider would do it. They only do, you can tell me if this is appropriate. So there are like 45 customers and they only did an analysis of the top 5
Well,
of and of vendors, like the top 5 vendors that, we spend the most money with.
you mean like as a percentage of revenue?
Mhm. Percentage of sales. So, mhm.
But they looked at the customer concentration for you.
Yes. Yes. And in the customer concentration analysis, they took the top 5
Yeah.
over the 3 years and showed how much revenue it
Okay.
came and what percentage of the total, revenue came from
Yeah.
each one. Now, I
Yeah.
had done that on my own
Yeah.
because I didn't realize they were gonna do that when this first
Right.
happened. So they did that over 3 years, and that is something folks should expect, correct?
Well, it's hard to say expect because in the SMB space, we have all these QV lights and people trying to adjust for the customer. So
Mhm.
so for 45 customers, they could have done it all, right? But would you have wanted to pay for it all? Sometimes,
I did it myself, so
yeah, but it's only 5, right? So sometimes, a different company has 1,000 customers, like so,
yeah.
and that's where when you say what to expect is, I definitely think you want, revenue per customer, you want some headcount analysis,
Mhm.
um, but there's so many more metrics. Like if they were doing it for a private equity shop, they would probably take the metrics they gave you and just multiply. So
What do you mean to, just multiply?
add more metrics. There's
Oh,
more analysis that can be done.
mhm.
Um, but if the customer doesn't value it, then, like if we have a standard QOV, which is robust, and then we have additional analysis that we'll do if it's a private equity shop, because they're going to want to dig into more numbers. They're going to want more data. They're going to realize they can only make imperfect decisions, but the more data they have, the more likely they are to make better decisions. They also realize the QOV is saving them from bigger problems. So
Yeah.
much better to have paid for a QOV, found problem, walked away, than now be stuck with a business you got to turn around or has massive issues. So
Yeah,
it's a
that
different perspective.
25K is well worth versus
Somebody
25
like,
million. Yeah.
yeah, I don't want to do a $20 million or sorry, a 20K QOV, but I will take on um, a $2 million loan with a personal guarantee on the home that my children live in.
That makes no sense. So here's a couple other things that's in this one that I thought was good, the QV.
Yeah.
It's a section for accounts receivable
Yeah.
aging,
Hmm.
okay? Then there is one for accounts payable aging,
Hmm.
and I mentioned vendor concentration analysis. And then there is quality of working capital.
Hmm.
Okay. So there's two sections for that. There's the historical unadjusted and then the
Hmm.
adjusted. Okay.
Okay.
So that's something. Then there's a section for cash deposits to reported revenue reconciliation. So that's
Cash
where you consider
reconciliation.
proof of cash.
Proof of cash or cash reconciliation, same thing.
Yep. Yep. So that's what the title is called for that. And it does it for um over a 12-month period. Okay.
Usually it's you can do longer than 12, but usually it's 12 because it adds more costs and then people don't want to pay for that. But yeah, 12 is average.
Okay. Oh, great. Okay.
Yeah.
So,
And then even on the balance sheet, you could have I don't know if that company had debt like items you might look at. There can be additional working capital narrative on top of that. Again, cash conversion circle could have been in that balance sheet analysis. So
yep.
again, more metrics that you can put in. If there's an equity role analysis of what that, if the seller is maintaining some equity, rolling over that equity analysis, what that would look like is something that might also go in that section.
All right. So yeah, like I said, the detailed trailing 12 months of
Mhm.
net working capital. Um, but I was still concerned about that, being that in the other deal, I found the working capital would not have been accurate based upon them like throwing in last minute like revenue.
Yeah, I mean, when you have a revenue spike in year one, you want to understand what happened
Hmm.
and how. I mean, did they just close it? Did they just close something in a different year to? I mean, there's lots of things they could have done. They could have just
Yeah,
closed.
whether they're doing
Yeah.
cash accounting or accrual as well.
Yeah, yeah, that's true. But you could also just be like, okay, we're gonna push sales and we got a bunch of stuff. So if we close this December stuff in January and then we push hard for this year, then that's another way to increase revenue. So if you see revenue increase, and then depending on the cycle of the business, like there was one situation where the seller sold a bunch of stuff and the seller's a salesperson among with other people, and they prioritized in production all the stuff they sold. So then after the person bought it, all the stuff that everyone except the seller sold is now behind by like 3 to 6 months. So
Wow.
when you see increases in revenue, you should also see some kind of increase in costs associated to
Right.
meet that revenue.
Mm.
Whether it's people or, you should be looking for things like that. But it also depends on the cycle. Do they sell it now, but it takes them 8 months to produce it? So you got to start thinking about that too. So if they sell it now, it takes them 8 months to produce it, and you're going to buy it in month 4. How are you going to cover those costs for those 8 months? That's where the
Mm.
working capital needs to be talked about in the LOI. So usually people do the LOI with their lawyer, but then they don't want to involve somebody who does the financials in the LOI. So now you've signed an LOI where working capital is probably going to be your biggest problem for the first 6 months to a year.
Mhm.
And you didn't get the one expert who is focused on working capital in the LOI. And so that's also one of the things that kills deals at the end.
Yeah.
Because this is kind of like, well, why do you need working capital? It's like, well, I need to pay people for the first 3 to 6 months, or I need to buy inventory, and
And they're
really,
like, "Hey, that's your problem. It's your business." Some sellers be like,
and
"Hey, that's your problem." You're like,
that's great. And so if you think that the business is worth it at that price for you to take that on, go for it.
"So be it."
But if you can't, if you don't have the money for it, you need to negotiate that early on. Or if you just think that's a part of what you should get, like it's a valuation,
Mm.
right? Like
Mhm.
on their side, it's kind of like, what do I have to lose? So on your side, it's, do I have the cash to come up with it? And even if I did have the cash to come up with it, would I? So for example, not parallel, but Warren Buffett would often pays 40% of the market price of a business because he has a reputation not to bother the owners. He has money.
Yeah.
He's still that just but he's like, well, my business is based on the fact that I buy great businesses at great prices. And sometimes the great prices are the reputation of the seller can sell to me. They know I'm not going to break it up. I'm going to give them a lot of freedom and a lot of levity. So right there, he already gets a huge value because he didn't pay the full market price for it. So
Mhm.
even if the person says it's your thing to deal with, so you and if you have investors kind of have to decide if that makes sense for how you guys want to buy the business, and also the relationship you want with the seller post close. The seller that says if you want them to be around for a while, if they're already telling you it's your problem, that's probably not the type of seller that you want
Mhm.
around year over year, because they're telling you exactly what they're going to tell you when you run into that operational problem in month 2.
Mhm. Yep, you're right. Okay, I'm gonna let
Yeah.
you go. I know I've held you over, but one
Agreed.
final question, one final question.
Last question.
Last question. At what point in this process should a buyer insert your services? Right? At what point? You mentioned LOI, you
Before
mentioned
you sign
different.
the LOI, because then we can
Okay.
start to look at working capital. Working capital kills deals, period, at the last minute.
Okay. You heard what she said, y'all. You heard her. All
Yeah.
right, Yvette. Okay, how can folks find you? I'm gonna link it in the show notes.
Yeah. So you can find me on LinkedIn at Yvette Owo. No one else has my name. Super simple. On Twitter at, surprisingly, Yvette Owo. So you can find me on both of those platforms and reach out if you're interested in accounting, QOE. So on the accounting side, it could be bookkeeping, taxes, and then on the financial side, like CFO, forecasting, that type of stuff. Yeah, so reach out.
Well, thank you. I just referred someone to you last
Yeah,
week. So
yeah,
I appreciate you so much. And I'm sure this is definitely critical information for our audience. So thanks again.
yeah. You're welcome.
Thanks for joining us on the Acquisition Chronicles. Today's episode hopefully gave you some key takeaways and reminders. We appreciate you listening. And if you found value in today's discussion, please share the podcast with someone who might benefit. We'll be back next Tuesday. Thank you for listening to the Unpolished MBA podcast. To hear more episodes or to request to become a guest, please visit unpolishedmba.com.